Thanks, Karuna. Hello, everyone, and welcome to Infosys earnings call to discuss Q4FY18 earnings. I'm Sandeep from the Investor Relations team in Bangalore. Joining us today on this call is CEO and MD Mr. Salil Parekh, COO Mr. Praveen Rao, CFO Mr. MD Ranganath, President, and the other members of the executive management team. We'll start the call with some remarks from Mr. Salil Parekh and Mr. Ranganath on the recently concluded quarter and year, as well as remarks on the upcoming year, subsequent to which we'll open up the call for questions. Please note that anything which we say which refers to our outlook for the future is a forward-looking statement, which must be read in conjunction with the risks that the company faces. A full statement and explanation of these risks is available in our filings with the SEC, which can be found on www.sec.gov. I'd now like to pass it on to Mr. Salil Parekh.
Thanks, Sandeep, and good morning and good afternoon to everyone on the call. This is Salil. With me are Praveen, Ranga, and several of our leadership team here for the call reporting our results for fiscal 18 and for the Q4 updates. I'm delighted to share with you those results, also share with you highlights from our strategic direction going forward, and share with you the guidance for fiscal 19. In Q4, we had strong revenue growth of 9.2% year-on-year and 1.8% quarter-on-quarter in reported terms. Our operating margin in Q4 was 24.7%. For fiscal 18, we had revenue growth of 7.2% in reported terms. Our operating margin was 24.3%. Our financial services business grew 7.2% year-on-year in Q4, energy and utilities 16.1%, and our Europe geography grew 22.5%. These highlights of our results show the robustness, demonstrate the underlying strength of our business, the trust of our clients, and the dedication of our employees. Now let me share with you something about our strategy going forward. The main inputs for our strategy have come from my interactions with our clients, our leadership, our employees, and a review of our business portfolio. The four key pillars of our strategy are: first, scale, agile, digital. Really focus on the digital services business, of which we already have 2.8 billion in our current portfolio. It represents 25% of our revenue for fiscal 18, and it's growing at a very strong pace, much ahead of the overall growth of the company. This is an area that we plan to invest in and expand and become more and more relevant for our clients' future. The second is energize our core, apply intense automation and artificial intelligence to improve productivity in this area. Here we will apply a market-leading NIA platform across all of our delivery. Third, reskill our employees. We will provide anytime, anywhere tools for enabling our employees to be ready for the client needs of the future. And fourth, we will expand localization in our markets, especially in the U.S., by building delivery centers, training centers, and hiring locally. For example, what we've done in Indiana recently and in Connecticut, and with plans for several others that are upcoming. And also pursue the same approach for localization in Europe and in Australia. These four elements, these four pillars of our strategy are then centered around what we do with our clients, which is navigate your next. We help our clients navigate their journey to their digital future. Now for our guidance. Our guidance in constant currency terms for fiscal 19, revenue growth between 6 and 8%, and operating margin between 22% and 24%. With that, let me hand it over to Praveen.
Thanks, Salil. We had a good quarter on the operations front as well. Our share of revenues from digital services improved to 26.8% in quarter 4, And for the year FY18, percentage of revenues from digital services stood at 25.5%. During the quarter, we had 10 large deal wins with TCV of $905 million. 6 of these were in US, 3 in Europe, and 1 in rest of the world. Utilization excluding trainees remains stable at 84.7%. Volumes grew 1.1% while realization was flattish in constant currency, aided by higher proportion of new services in our portfolio mix. Attrition has increased slightly to 16.6% as compared to 15.8% in quarter 3. However, our high performer attrition is significantly lower at 9.4% compared to 14.1% last quarter. We are pleased to announce compensation revisions for approximately 85% of our workforce effective April 1st, both on-site and offshore. Rest of the employees, managers and leaders will see their revisions effective July 1st, 2018. We will continue our focus like we did last year on a sharper differentiation based on performance and contribution. Most of the people could see increases ranging from mid to high single digits. Variable pay for the quarter is 100%, highest in the last 10 quarters. In addition, we have earmarked $10 million special incentive to employees. Now, let me give some color on some of the sectors. Demand in financial services is strong in new services like digital, cloud, RPA, AI, and automation, wherein budgets are being diverted from run the bank and regulatory spending to change the bank initiatives. Clients are engaging with us strategically in digital transformation and new services, which is helping us increase our wallet share. Certain top accounts in U.S. are witnessing some softness. However, regional banks in U.S. and Europe continue to be strong growth drivers for us. We have a strong franchisee in investment management, cards and payment, and mortgage servicing. We have won several large vendor consolidation deals in Europe. Our large deal pipeline is healthy, and pipeline for new deals is showing a steady increase. In insurance, we have seen tremendous growth in the last year. The insurance industry continues to be impacted by changing technologies and consumer behavior, and insurance companies are under pressure to innovate fast and reduce spend. However, our service combination of design technology with implementation expertise meets critical needs of the insurers to modernize their digital experience. We expect growth for us in the vertical driven by large deals, new account openings, and our offerings around Mechanish and Nia. Demand in manufacturing sector remains moderate, coupled with flat to low client spending budgets, driven by cost-cutting objectives. The sector is looking towards digitization of end-to-end processes with focus on integrating mobile, IoT, and back-end systems. There is higher activity in Europe, which is going through an outsourcing wave. Our deal pipeline in the sector is healthy, and we have also generated new logos in this industry. Healthcare is witnessing increasing demand driven by population growth, aging population, and increased sickness. There is a strong focus on pay for performance with operating models being linked to specific outcomes and technology-led personalization of care. Legacy modernization, digital health and analytics, and care management are the other key drivers. Discretionary spend is flat, while non-discretionary spend is focused on cost optimization and consolidation. Retail sector in U.S. continues to see a slowdown, especially due to store closures and Amazon effect. However, growth momentum in Europe and rest of the world is better as clients accelerate their digital transformation agenda. Clients are investing towards cloud adoption, infrastructure outsourcing, and transformation around digital and omnichannel. Growth in source vertical was led by ramp-ups in large deal wins of last few quarters, coupled with traction in key accounts. Demand continues to be strong on the back of opportunities in newer areas like analytics in energy, IoT in communication, cybersecurity in telcos, and smart meter opportunities in utilities. Overall demand for BPM is moderate, driven by commoditization on one hand and automation and AI on the other. Among segments, source is witnessing traction, whereas FSHL and India business witness some softness. Clients are expecting increased automation-led productivity gains led by RPA. The set of vertical solutions and capabilities created to provide customized solutions to the industry verticals are proving a major differentiator for us versus peers. Deal size and number of deals both are witnessing an upward trend. Our strategy of reimagining BPM and strong focus on analytics, RPA and digital will help counter the commoditization impact and grow at above industry rate. Digital transformation is one of the top agenda for all clients with increased focus on customer centricity, buyer satisfaction, increased loyalty, and lower cost of service. Clients are increasingly seeking Infosys help in navigating digital transformation to create more relevant and durable solutions in the complex world. We are making significant investments in new services, scaling our digital capabilities to support extreme automation and processes, organizational and infrastructure modernization, enterprise agility, cyber security, and digital experience. Acquisition of design consultancies coupled with digital nearshore and offshore studios will result in improved time to market, accelerated speed to volume, and optimized costs for clients. Opening of design and innovation have been Rhode Island will help close the gap for design and human-centric skills in technology fields. Going forward, we expect shift of budget towards modernization of legacy systems and increased focus on digital transformation to meet rising customer expectations and deliver individual experiences at scale. Over to Ranga to provide some color on the financials.
Thanks, Salil and Praveen. Hello, everyone. Before I go to the details of Q4 performance, let me step back and look at the overall performance of the company in fiscal 18. In fiscal 18, the company delivered good performance and resilience on multiple fronts. Let me talk about a few key aspects of fiscal 18. First, the annual growth of 7.2% in reported currency and 5.8% in constant currency and 3% in rupee terms was on the back of good growth in digital revenues. The digital revenues exceeded 25% of the total revenues of the company. Further, we increased the number of $100 million clients to 20. Second, our operating margin for the year was resilient at 24.3%, driven by broad-based improvement in several operational parameters, productivity improvements, and automation benefits. Revenue per employee increased by 6.3% during the year and crossed $54,500. This was primarily driven by the fact that the revenue growth during the year was faster than the headcount growth due to the higher utilization and productivity improvements. While revenue grew by 7.2%, the headcount growth was just 1.9%. Our operating margin for the year was the above midpoint of our guided range of 23 to 25 at 24.3%. Our operating margin for the quarter improved by 40 basis points to 24.7. I'll be providing more color on this shortly. Third, our cash generation for the year was robust at $1947 million, a growth of 15.3% as compared to 7.2% of revenue growth. Coming to capital allocation, during the year, the company successfully executed the capital allocation policy that was announced in April 2017. As part of the policy, the company completed successfully its share buyback of up to $2 billion. Today, the board, in its meeting, reviewed and approved the capital allocation policy of the company after taking into account the strategic and operational cash requirements of the company in the medium term. The key aspects of the capital allocation policy are: 1, the board has decided to retain the current policy of returning up to 70% of the free cash flow of the corresponding financial year in such manner as may be decided by the board from time to time. In addition to the above, out of the cash balance on the balance sheet, the board has identified an amount up to $2 billion to be paid to shareholders in the following manner. A special dividend of rupees 10 per share, resulting in a payout of approximately $400 million, B, the board has identified an amount of up to approximately $1.6 billion to be paid out to shareholders for the financial year 2019 in such manner to be decided by the board, subject to applicable laws. Further announcements in this regard will be made as appropriate in due course. Now let me talk about Q4 revenues. Our revenues in the quarter were $2,805 million. This is a sequential growth of 1.8% in dollar terms, 0.6% in constant currency terms. In rupee terms, the revenue for the quarter was 18,083 crores. This is a sequential growth of 1.6%. As compared to Q4 of last year, revenues grew 9.2% in dollar terms, 6.4% in constant currency terms, and 5.6% in rupee terms. Let me talk about volume growth and price realization. Sequential volume growth for the quarter was 1.1%. As compared to Q4 of last year, the year-on-year volume growth was 6.2%. Pricing realization for Q4 improved by 3.5% on year-on-year basis. For the full year, as compared to fiscal 17, which is a better indicator of price realization, the price realization improved by 1.5% in reported terms and by 0.2% in constant currency terms. We ended the quarter with a total headcount of 204,107 employees, which is an increase of 2,416 from last quarter. In fiscal 18, the net headcount increased by 3,743 employees as compared to the net addition of over 6,000 employees in fiscal 17. Coming to operational efficiencies, our relentless focus resulted in improvement of several efficiency parameters in fiscal 18. Utilization excluding trainees for the year improved to 84.6% from 81.7% in the previous year. Similarly, our efforts towards moderation of on-site mix resulted in on-site mix decreasing to 29.3% this year. In Q4, this further reduced to 28.7%, which is the lowest level in 12 quarters. Our focus on optimizing on-site employee costs, including sharper focus on productivity, on-site pyramid, and other localization and cost optimization measures, led to a decrease in the on-site employee cost as a percentage of revenue to 38.3% in fiscal 18 as compared to 38.7% previous year. The subcontractor expenses this quarter stood at 6.1% of revenue as compared to 5.9% of revenue last quarter. As you know, the subcontractor expenses are driven primarily by utilization levels and on-site talent demand. Our operating margin in Q4 was 24.7%, which increased sequentially by 40 basis points. Currency movements helped the margins by 20 basis points, which was fully offset by a drop in utilization and price realization. Further, reduction in on-site mix and other expenses improved the margin by 70 basis points. This was partly offset by higher variable pay and increase in compensation costs by 30 basis points. So overall, this led to an improvement of 40 basis points sequentially. Cash generated from operating activities in Q4 as per IFRS consolidated was $515 million, and we paid $74 million of taxes as per the APA entered into with the United States IRS. Free cash flow, which is operating cash flow less CapEx for the quarter, was $418 million. For the full year, fiscal 18, free cash flow was robust and increased by 15.3% as compared to the revenue growth of 7.2%. Cash and cash equivalents, including investments, stood at $4,873 million, which converts to approximately 1,765 crores. For fiscal 2018, the board announced a final dividend of 20.5 shares. After including the interim dividend of 13 per share, the aggregate dividend for fiscal 18 amounts to 33.5 rupees per share. The total payout amounts to approximately 70% of free cash flow for the financial year, which is in line with the capital allocation policy announced by the company in April 2017. Debtors Outstanding for the quarter decreased by 3 days to 67 days compared to 70 days last quarter. Capital expenditure for the quarter was $97 million, which is 624 crores. Yield on cash for the quarter was 7.29% as compared to 6.9% last quarter, slight improvement in the yields. Our hedge position as of March 31st was $1,513 million. In fiscal 18, the EPS growth was strong at 17.8%. EPS for the year was 1.1, and this includes positive impact of 9 cents on account of APA, which was concluded with the United States IRS during the year. In the quarter ended March 31, 2018, on conclusion of the strategic review of its portfolio of businesses, the company initiated identification and evaluation of potential buyers for its subsidiaries Calidus, Kava, and Panaya. On such reclassification, an impairment loss of $18 million in respect of Panaya has been recognized in the consolidated profit and loss for the quarter and year ended March 31, 2018. The corresponding write-down in the investment value of Panaya in the standalone financial statements of Infosys Ltd is $90 million. Coming to operating margin guidance for fiscal 19, we guide operating margins in the range of 22 to 24%. This is primarily an account of focused investments in digital to leverage digital opportunity in underinvested areas, enhancing our investments in U.S. talent model further to foolproof our future business, revitalizing sales for tapping market opportunities, and repurposing of talent. At the same time, as in the last year, we continue our relentless focus on productivity, operational efficiency, and cost optimization while focusing on digital growth. With that, we will open the floor for questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Joseph Ferezi from Cantor Fitzgerald. Please go ahead.
Hi. I wanted to ask about margins first. You know, I think why the revision lower, and I think there have been a couple of revisions lower over the last couple of years. Do you feel like you've taken them down far enough?
Hi, this is Ranga here. I think if you look at last year, we guided 23 to 25. We ended up at 24.3, higher than the midpoint. I think one of the, I want to emphasize that we'll continue our relentless focus on all the parameters that I talked about, as well as the productivity and the cost optimization. What we have done really is, as part of our business review that we did, we looked at areas where digital areas, especially where we need to invest more to leverage the opportunities, point one. Second, on the U.S. talent model, we have planned for additional investments so that the growth is not compromised in the United States. Third, we have also looked at revitalization of sales to see, especially in respect of pursuit of large deals and conversion of the same, and also repurposing some of our talent in the digital areas. While I think what we will do is, as the year progresses, this is the range we have given, but as the year progresses, we'll certainly be able to provide more color on how we are progressing on those 4 investments. But nevertheless, our relentless focus on the optimization and productivity will continue.
Got it. So let me ask a kind of a different way. Do you feel like you're at your natural long-term level of margins exiting, next year? And if not, what utilization's obviously gone up, so I'm wondering what leverage you have to continue to maintain the margin level that you have.
I think we're confident of retaining the guidance range in the current 22 to 24. We're confident about it because we also believe that some of these investments are required for leveraging the digital growth, in the near term. So we are confident of this range in the medium term.
Okay. And then the last one for me, can you give us some color on how fast digital grew for you and what your expectations for a growth rate in that business are going forward? Thanks.
Hi, this is Salil. In terms of digital, we've started to really track and look at it very carefully for this fiscal 18 which just closed for us. In Q4, digital has grown 3.6% over Q3. We see that sort of a trend is something that we would push for. We see the market certainly growing at a large level. Our overall digital number of 2.8 billion, as we've tracked it and looked at it carefully in fiscal 18, we'll start to see comms in fiscal 19 as the quarters roll in. We also see that the overall addressable market for this business is somewhere in the range of 180 to 200 billion, and that market is growing quite strongly. So we expect this to be one of the growth drivers for us in the future.
Thank you.
Thank you. The next question is from the line of Ananthanarayanan from Credit Suisse. Please go ahead.
Thank you and good evening, everyone. I had a couple of questions as well, and the first one is to Ranga, again on the margin issue. So, Ranga, when you spoke about those investments being the reason for ratcheting down your margin range, are there any one-off elements in those investments, or should we sort of expect such investments to continue just given your size and growth? And if the latter, then what sort of top-line growth would be required to get your margins back to that 23 to 25% range?
Hi, this is Ranga here. I think, sorry, you were saying something?
Yes, sorry, Ranga, just to clarify, this question was related more from a 3-4 year perspective rather than just for FY19.
Yeah. So as I said earlier, we ended the year at 24.3, and Q4 was robust at 24.7. And the guidance that we are given, 22 to 24, primarily takes into account some of the investments. They're not one-off, big-ticket, single investment that we need to do. It is not like that. It is not really a chunky investment. We're looking at all the top accounts and also the service lines where we have more potential to grow, primarily investing in the capabilities, primarily investing in certain IP wherever required to drive the digital growth. It is not really a large chunky investment that we're looking at. And of course, this will be very gradual and progressive during the year, depending upon how those investments pan out during the year. Certainly, it will have necessary impact on the margin. But at this point in time, what we have assumed is really all these investments that we're going to make throughout the year. But of course, we are conscious of the fact that for the overall EPS and earnings growth, the margin dip has to be more than be compensated by the revenue growth to retain the EPS growth. I think that's in the medium term. So I think we are very conscious of that fact. I think this is a balance between how we need to really look at focused investment digital areas where we feel that there is a large opportunity that we need to leverage.
And, on the second part of that question, Ranga, see, over the next 3 or 4 years, would a single-digit growth suffice for you to manage your margins at the existing levels?
Well, I think, one of the factors that I would like to emphasize, the margin lever that we are looking at here is not necessarily the cost optimization levers alone. One of the things is the digital revenue that we have talked about, 25.5% for the year, is coming at higher price points. And not only higher price points, it is also delivering us better gross margin than the core IT services. So our our emphasis or endeavor would be to drive that price points and gross margins in digital better during the year. And that is something that we're also working on. So our overall objective is that a combination of faster growth in digital services, which could be at higher price points and gross margin, need to offset the other impact of the margin growth on the EPS. To answer your questions, I think we are comfortable with this range, and we will watch during the year. This is the range that we have made certain investment assumptions to drive growth, and we are comfortable that even with this kind of band, broadly the earnings in the medium term need to be protected through multiple levers, including digital profitability.
Thanks, Ranga. And just one more question, addressed to Salil. So, Salil, on this, when we at least look at it on paper, both Panaya and Scava, seem to fulfill some of the criteria among those four elements of your strategy that you laid out. So maybe could you just detail for us, the reasons why you decided to get rid of them?
Hi, Anand. This is Salil. I think the approach we've laid out in the four elements with Agile, Digital, Energize the Core, Reskill our people, and Localize, those are the go-forward strategic elements which then drive to building out a digital services revenue space, the 2.8 billion that I talked about before. And within that, we re-emphasize what we have on a platform basis, for example, Mia or McCamish, what we have in insurance, or certainly products such as Finacle and Edge. When we looked at Panaya and Scava, the approach we've taken is we've initiated a process for evaluating identification of a potential buyer for these. There are several criteria internally that we looked at that we would need for all of our businesses to fit for them to scale. And there were some of those criteria that Panaya and Scava did not meet at this time. The commitment we have with our clients is to ensure that those two product areas are something that the current clients we're working with and clients in the future that are using this, we remain committed to it. And that's the approach we've taken in terms of the strategic review we put in place today.
Thank you, Salil, and good luck for the new fiscal year.
Thank you. The next question is from the line of Keith Bachman from Bank of Montreal. Please go ahead.
Hi, thank you. I had two questions, if I could. The first is also on margin, but I wanted to just understand the strategy as it relates to on-site and offshore. In the March quarter, your offshore effort and revenues actually went up a little bit, but I would assume pursuant to some of the strategy elements you laid out that, in fact, your on-site revenues and effort would go up during the course of the coming year and years thereafter. And I just wanted to understand, A, is that true? And B, what are the implications to margins as you pursue more digital activities given the weighting of on-site and offshore? And then I have a follow-up, please.
Yeah. Hi. Let me take that question. See, I think one way to look at it is really segregate our on-site revenue into two components. One is digital and non-digital. And even if you look at the overall company, we're looking at 25.5%. And when we looked at the gross margin of this 25.5% of the business, it is higher than the core IT services, and it is higher than higher than the company's gross margin. So the areas, of course, digital is not a homogeneous business mix. It has got a very wide range of services there. But with the pricing discipline that we have, we are confident of achieving better price points in the digital revenue. even if it is higher on-site component at this stage, based on what we see, we do believe that the gross margins will still be higher than the core IT services. So to answer the question, the emphasis on digital revenue growth not necessarily mean that those revenues, because of higher on-site component, are coming at gross margins. As today, that is not the case. So I think the primary focus of the margin is really to drive further digital without diluting the gross margins that we are getting in digital with better price points, and at the same time make sure that we are leveraging the opportunities across our top accounts and in new service areas that we have identified.
Okay, fair enough. Thank you for that answer. My second question really relates to capital allocation versus M&A. And you've laid out a strategy where you're paying out 70% of your free cash flow and also going to pay a special dividend. With that said, Infosys, like a lot of the Indian-based IT providers, service providers rather, is facing structural challenges. And if you look at Accenture over the last 5 to 7 years, has put a heavy emphasis on M&A to rebalance or remix the portfolio. And it just seems to me the risk you're running is weighted towards the capital allocation as not being able to remix your portfolio at a rate that will allow you to either maintain or accelerate your revenue growth. So while this is a tricky balance, admittedly, it just would on the surface seem to suggest that perhaps you should be weighing more to the M&A side. So if you could just speak to the capital allocation strategy that you've laid out today and what emphasis that you're going to place on M&A over the next 12 to 18 months to try to help rebalance your portfolio.
Hi, this is Salil. I think in terms of the capital allocation policy, there's two components to it. The first is up to 70% of our free cash flow from our ongoing cash generation. And then the second one being $2 billion from what we have on the balance sheet today. That still leaves us with quite a significant amount on the balance sheet, in addition to the ongoing cash generation that we will continue to drive into. We've developed today at least a first view of what are the opportunities in the M&A space. And we are proactively looking to see what of those we could leverage into this digital service architecture around the definitions that we've built internally for our future scale-up. You also saw the announcement today of the acquisition that we did in what we call the experience space or digital, related to the digital creative agency. We want to continue to do those types of acquisitions and indeed others across that digital landscape that can help us and position us in this transformation. However, we are also conscious that we have a significant amount of cash on our balance sheet, and that's the reason for the capital allocation policy, which relates both to the ongoing cash generation and what's sitting today on the balance sheet.
Okay. Thank you, and best of luck to you.
Thank you. The next question is from the line of Moshe Katri from Wedbush Securities. Please go ahead.
Hey, thanks. Can you talk a bit more about some of those investment buckets? I think you mentioned 3 or 4 on some of your earlier interviews. And then in that respect, maybe you can talk from a big picture perspective about strategy for the next 3 to 4 years. Are we going to see any deviation from what we've seen in the past? Maybe a couple of pointers here could be helpful. Thanks a lot.
On the investment buckets, the approach we've taken in planning for our fiscal 19 relate to investments in 4 areas. First, building out digital capabilities. So our own internal investment in scaling up, training, recruiting, and in general, giving utilization benefits to building digital capability. Second is to expanding our sales capability and allowing that to become more focused in the growth areas, both in sectors, geographies, and also in the service offers. The third relates to our localization approach. In the first instance in fiscal 19, investments in localization in the U.S., both for talent but also for building up delivery center capabilities and training capabilities within the U.S. And the fourth relates to refactoring and reskilling of our employees, and that cost as it relates to aligning to our future direction, namely on the digital and cloud platforms that we are working towards. In terms of the second question on our direction for the next, I think 3 or 4 years, as you described, it's centered around 4 pillars for us. The first is the scale up of our digital, agile digital business, which is today $2.8 billion and growing rapidly. The second is to energize our core with AI and automation. The third relates to reskilling our employees for this future digital roadmap. And the fourth relates to expanding localization in the U.S. and in other geographies that we operate. That direction is that is the direction that we've set now for the go-forward period, and we expect to stick with it in the coming years.
Great. And then just final question. This is a big picture question. There's a lot of optimism, I guess I'm on the sell side, the buy side, that we may see that uptick in demand this year. Based on conversations that you're having out there with clients, are we kind of getting there? Or at this point, this is still kind of up in the air, just given the fragility of the environment and given the geopolitical uncertainty out there? Thanks a lot.
If I understood that well, it was in terms of client demand and optimism. What we see today, there are segments where there's significant optimism and growth. For example, energy and utilities. There are geographies, for example, the European geography for us, or even what we define as the rest of the world. Overall, in the areas we have defined in our agile digital service architecture, there's significant optimism and quite a lot of opportunity for growth. As those areas become scaled for us and our investment starts to yield returns, that's the area where we see the most dynamic growth and opportunity in the market, and hopefully we'll leverage that as we execute on it.
Thank you.
Thank you. The next question is from the line of Divya Nagarajan from UBS. Please go ahead.
Hi, thanks for taking my question. I have actually 2 questions. One is on the direction of M&A. Your latest acquisition seems to be taking your M&A in a different direction, especially when coupled with the exits that we are looking for with Panaya and Scava. Could you run us through your outlook for how you're looking at M&A going forward? And my second question, again, coming back to the margin argument, Ranga, if you could just run us through at the lower end of your margin guide and higher end of the margin guide, what are the key elements that really contribute to the margins? I understand that you probably reached a certain limit on utilization expansion. We're already seeing headcount addition pick up. So if you could just break it down into utilization pricing and then the investment impact on your margins for the next 12 months, that would be very helpful. Thank you.
Hi, this is Ranga here. On the margin front, I think last year when we guided 23 to 25, we reduced by 1%, and we said primarily on account of rupee and to some extent the U.S. talent model. However, we delivered 24.3. Now this time, the primary reason for guiding in 22 to 24 is to tap the opportunities in digital and some of the investments that we need to make to tap those opportunities, as well as in repurposing the sales engine for some of the large new pursuits. Third, of course, is the additional investments that we need to make in the United States. These are the 3 principal pieces. Now, the way we are we do not want to kind of totally exclude these things, from our planning standpoint. We will see how these investments pan out during the year. And maybe after Q1 or Q2, we'll get a better perspective. But we want to make sure that we keep the range at 22 to 24 so that, the necessary investments if we have to make and as we make during the year, we'll address the margin aspect.
On the M&A question, I think the approach we want to take with, in fact, the announcement of the acquisition today is clearly centered on the digital services space. One of the components of that is the experience area, which is where this acquisition squarely fits in. We've started to look at what the landscape is for acquisitions in services across the various digital components, whether it's data, analytics, IoT, cloud. Those are the areas which are the detailed components of a digital service architecture where we'll examine acquisition opportunities. And those will be services plays that we will start to look at.
Got it. I'll come back for follow-up if we still have time, and all the best for the year.
Thank you. The next question is from the line of Parag Gupta from Morgan Stanley. Please go ahead.
Yeah, hi. Good evening, everyone. So, just two questions out here. Firstly, if you look at the deal trajectories that you announced today, they seem to be pretty strong. Now, looking at the numbers itself, we still probably haven't seen any significant pickup in growth rates across U.S. or, BFSI or retail for that matter. So just want to get a sense that is the deal trajectory, signaling an improvement in the demand environment going forward? So is it more forward-looking rather than the numbers which are possibly backward-looking? Or do you think there are some parts of the business that are actually dragging down overall growth? So that's my first question. And just the second question on the margins bit again. What I'm just trying to understand is, you made one point that there is going to be a lot more investments in digital, especially in areas that have, seen underinvestments in the past. What I'm just trying to understand here is that is this being driven by what you're seeing in the market and what clients are demanding for, or are some of these investments, something that you're making in advance, given the way the market is beginning to shape up? So just trying to get some clarity on that. Thank you.
Hello, this is Praveen here. I will respond to the first part of the question. For this year, we have seen tremendous growth in insurance services. We have seen tremendous growth in energy and utilities and in the telecom space. We have also seen good growth in the life sciences and healthcare space. On the whereas growth on the manufacturing side and on the BFS side of BFSI, as well as on the retail side, growth has been moderate. In the coming year, we expect to see continued growth in energy utilities. We expect to see the momentum continue in telecom as well. We also expect to perform better in BFSI than what we did this year. This year, if you ignore the impact of one of the large project cancellations last year at RDS, if you normalize it, the growth of BFS would have been on similar lines to company growth rate. And in BFS, we have a much diversified portfolio. We have got strong presence in Europe. We have strong presence in regional banks as well. So while we have seen some softness in large banks in North America, not in terms of spending, but more in terms of diverting more spends internally rather than through outsourcing thing. Other than that, I think there is definitely continued spend in BFS space. So we remain optimistic about this space, but it remains to be seen, particularly in the North America, whereas we have seen good growth in both Europe as well as rest of the world. From a large deal perspective, as I said earlier, we had won 10 large deals, $905 million in revenues. 4 of these deals were in financial services and 3 in CRL space. And this $905 million is the highest TCV in this quarter for this particular year. And total TCV was about $3 billion from large deal. The pipeline continues to be healthy, and it's across different sectors as well as service lines. So net-net, while we have seen good growth in few verticals, we have seen good growth in some of the geographies like Europe. We have seen some softness in North America, but that's not related to any macro environment issues. So we are hopeful that spend will start coming back to North America this year. Now coming back to where we are seeing some drags, from a sector perspective, we expect continued challenges in the retail space from our perspective. Apart from that, some of our businesses like consulting in the last year or two, we have had some challenges in consulting. We are still working on stabilizing and driving growth back in this area. While it remains central to our strategy, we still feel that it will work under progress, and we expect few more quarters of challenges before it stabilizes. I will pass on to Salil to respond to the other question.
Hi, this is Salil. In terms of where we are investing in digital, where in fact I was outlined before, within the space of digital, we have internally a detailed digital service architecture that we built. This comprises of 5 elements. And from that, we're investing in some places, for example, investing in the area of cloud, investing in the area of modernization of application landscapes, investing in the area of IoT, investing in the area of experience. So we've picked a few select areas within the digital landscape where we look to invest and scale up our capability to start to service the need that we see with our clients going forward.
Great. Thank you very much.
Thank you. The next question is from the line of Edward Kiso from Wells Fargo. Please go ahead.
Hi, good evening. I have a question around some of the accounting with the acquisitions. Are Panaya and Skava going to be treated as discontinued operations and therefore taken out of the historical numbers, or have they been taken out?
Hi, this is Ranga here. As per the IFRS standards, once we identify an asset held for sale, which is driven by the management's intention to sale, we have to reclassify all the assets and liabilities as assets held for sale and liabilities associated with that. After that, we have to do a fair value assessment, and we undertook fair value assessment from an independent valuer, and the $18 million of impairment loss has been recognized in the consolidated financial statements. And to answer your question, these are not discontinued operations. I mean, these assets will continue to be generating because they have revenues and they have cash flows associated with these assets. But we are classifying them as per IFRS as assets held for sale. And so accordingly, what has happened is in the consolidated balance sheet, we have called it out, both the assets and liabilities, and we have taken the impairment loss.
So the next related question is, how important were Panaya and Skava to some of your existing revenue, such that now you've indicated that it's for sale? Could it impact some of your existing revenue run rate?
Ed, this is Praveen here. We will continue to partner with them based on the irrespective of whatever outcome or shape it takes. We will continue to support our existing clients, and in future as well for any new prospects or clients, if there is a need or applicability of Skava or Panaya, we will continue to support that.
And my last question related again is the Wong duty, if I said that correct, acquisition. If you paid about 1 times revenue, call it $75 million, that's about 2.5% growth. Within the 6 to 8% guidance, are you assuming 2 to 3% from this acquisition?
You're talking about the recent acquisition? No, this is what we are given, 6 to 8 is the organic growth.
Is organic growth.
That's right.
Thank you. Thank you.
Thank you. The next question is from the line of Ashish Chopra from Motilal Oswal Securities Limited. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just one clarification on the previous question as well, Ranga. So while 6 to 8% is the organic growth, does it also bake in the course of revenues from Panaya and Skava as and when they get sold, or currently that is not embedded in the guidance?
Well, I think we have taken into account that possibility. Clearly, this is the organic growth.
Okay. And the second question was to Praveen. So, Praveen, you mentioned that overall spending in BFSI remains healthy, but there is this trend in certain clients in North America where they're taking the work back in-house. So, if you could just elaborate on, how secular or sporadic this is, as to whether it is really restricted to a very small set of clients, or do you see it happening across a wider set?
This insourcing is normally a cyclical trend we have seen in the past. If you look back over the last 10, 15 years, we have seen signs when we have seen acceleration of insourcing, and over a period of time it has stabilized, and we have seen periods where clients have also divested or sold those captives. So today we are seeing this primarily to some extent in the FSI space, and also to some extent in probably the RCL space. It's something we have been seeing in the last couple of years, I would say. There are two primary reasons from our perspective. One, obviously, given all the technology disruptions, clients are also looking at building that capability, and sometimes if the skills and capabilities are available in India, they want to tap onto that skills and capabilities. The second one is, as part of the digital transformation, one element of transformation is modernizing their legacy. And as clients are embarking on that journey, some of the clients have realized that they have outsourced too aggressively. They don't have resident knowledge in the legacy system, so we have seen clients increase insourcing for that purpose as well. That's a combination. Difficult to predict how long this trend will continue, but it's, we work, for us it's in some sense, while it has impacted growth to some extent, we also work very closely with captives. We also help in many cases in terms of helping them set up captives, providing training assistance, recruitment assistance, and so on. And in many of the cases, we have seen our book of business has also improved with increase in captives.
Got it. And just lastly from my side, on one of the investment areas you articulated for the margin guidance on revitalizing the sales, if you could just maybe throw some more light on that with respect to, are we talking about having more feet on the ground, or are we looking at, changing the kind of mix within our sales team, or what exactly would entail around that? Do we think we are probably sub-staffed, or is it a quality issue?
On the sales, what we'd like to do is expand what we have in terms of our sales capability. Our sales capability is very strong. However, there are areas and pockets where we can go after more subsectors. We can probably look something in a few European geographies. We also plan to do something where we want to introduce more digital specialists into our sales mix, and also to look at how we can work on account expansion programs within our sales mix. So the primary focus is to expand the sales capacity into newer areas, some which are service line based and some which are sector and geography based.
Got it. Thanks, Salil. That's it from my side. Wish you all the best.
Thank you. The next question is from the line of Rod Bourgeois from Deep Dive Equity Research. Please go ahead.
Hi there. Hey, during Vishal's time as CEO, he set a vision for Infosys that was more product-focused. And I guess my question at this stage is Infosys now planning to move back to more of a service orientation, or will Infosys maintain the general vision that was set by Vishal on the product and software front?
So the approach we've laid out really talks to scale out digital services space today. We have a huge strength in services, both in agile, digital, and our core services. That's the primary focus where we're driving the business. In addition to that, we have what I call scale platforms, like scale products and platforms, like Finacle, like Nia, which is a strong platform that we want to expand, like McCamish in the insurance space, like Edge. Those continue to be part of our future approach, but we absolutely want to be driven to build out a digital services business, which is the primary focus for where our clients are going in the future.
Got it. And hope to learn more about that maybe at the Analyst Day. The follow-up question is related to the margin guidance. Your guidance implies some potential for some margin contraction based on the investment plans that you've outlined here. I guess I also wonder if the margin contraction outlook is partly accounting for risks that could stem from contract profitability issues, given that your pricing has been somewhat more aggressive over the past couple of years. I'm wondering if the guidance is accounting for potential contract profitability issues that could stem from that.
This is Ranga here. No, that's not the reason. In fact, if you look at two aspects, right, even if you look at the pricing, this year in the constant currency basis, year-on-year, price realization has improved by 0.2%. I mean, it's broadly stable, unlike the earlier years where we used to see pricing decline in constant currency between 1 and 1.5%. Second, this is not due to any contract contraction either in the sales or in the margin. This is not account of any of those. It's primarily our objective of investing in certain areas to drive digital growth and the sales revitalization and the U.S. talent model. This is not to do with any specific contraction either in sales or margin.
So maybe the follow-up to that, just real quick, is you mentioned the price realization being up year to year. How much of that is due to mix, and how much of that is due to price improvement on apples-to-apples deals?
I think, it's very difficult to put a number on both the buckets. Price realization is a combination of two factors. One is, of course, the rate cards and the T&M. T&M is straightforward. It is rate card. In case of a fixed price project, is also a factor of the productivity that we achieve in a fixed price project after the commencement of the project, which is either through on-site mix changes and the total headcount in a particular SP due to a better productivity management in a fixed price project. So, as you know, roughly 50% of our revenues, little over 50% of revenues come from fixed price, and they have the on-site part as well. The second reason for uptick in price, or maybe not as much of a downward pressure that we saw in 2 years ago, is also we are seeing the digital, which is about 25.5% for our revenues, coming at better price points. So it's a combination of both.
Thank you. I'll yield the line and follow up on some other topics. Thank you.
Thank you. The next question is from the line of Ankur Rudra from CLSA. Please go ahead.
Hey, thanks. Certainly at a high level, Infosys has been espousing a strategy focusing on new services, artificial intelligence, automation, and also reskilling employees. So from your strategic reappraisal, are you sort of endorsing that direction, or are you making any kind of reprioritization areas? Any clarification that would be helpful.
Hi, Ankur. This is Salil. The approach we've laid out really is focused on building our agile digital services portfolio. That portfolio today, which is approximately $2.8 billion in revenue, is where we see quite a strong demand from our clients and a large market opportunity. This then combines with revitalizing or energizing our core with automation and AI and reskilling. So our focus and the localization in the U.S. Our focus is really very centered on the services aspects, plus scale platforms and products like Finacle, McCamish, Nia, and Edge. The objective here is to be building relevance for where our clients' digital journey is taking them and making sure that we are investing in and building up the capability sets to help them with that. But again, very much in the services space.
Okay. And just a follow-up on your guidance, I understand over the course of last year, the commentary on banking perhaps changed a bit. You know, we were all hoping for a bit of a spend recovery, which got delayed several times. Are you saying in the new guidance you're still baking in a recovery in BFS spending, or is that actually an upside to the guidance you've laid out?
Ankur, this is Praveen here. We have factored all the estimates or assumptions we have had on each of the sectors. And as we have said in quarter 3, in the coming year, our expectation is we will do much better. It remains to be seen how much it is, but based on whatever visibility we have factored that in the guidance.
Okay, so your comment, just to understand your commentary on banking, you're saying banking spending should improve in FY19, is that the comment?
No, we do. I mean, today, when you look at banking, there is some softness in Americas. There is spending, but as I explained earlier, some of the spending is being diverted to internally, to captive setup. So that's in the America side. On the Europe side, we continue to see good traction. We are also seeing a lot of spend in super regional and regional banks in North America, where we have good presence there. So it's a mixed bag. We believe that our portfolio mix, our diverse portfolio mix will help us in capturing whatever spend that's out there towards outsourcing. So from our perspective, while this year I have explained, while we have had a muted growth, but I mean, if you normalize for the impact of RBS, then our growth would be in line with the company growth. So we do expect next year growth to be better. And spend to come back to North America, but it remains to be seen. But based on our estimates, what I have said is our guidance factors into all these uncertainties as well. We have made some estimates and that's factored in the guidance.
Okay. And just for the margin guidance for next year, Ranga, if you could clarify, obviously you've baked in a lot of things here. I think you're baking in, stronger wage hikes, bonuses, variable components as well. But how much of the lowering of the guidance is because of the step increase in local mix, new skills, and investments versus the lack of operating leverage from existing levers that we had in prior years, like utilization, on-site role ratios?
Hi, this is Ranga here. I think, two aspects. One, of course, is really the priority areas of investments that I talked about. That is the primary one. And we do believe that the digital revenue, which is 25.5, as I said, is coming at higher price points and also higher gross margin as well. We do believe that the rate of growth in digital should, kind of minimize the impact of the core IT services pieces that you mentioned. Even if you look at in the core IT services, the three things that we have been able to successfully do, of course, is utilization, which is, we already said that, at the current level we are comfortable. Coming to on-site mix, it has come down below 29 this quarter, and we do believe that, we'll continue to focus there. The third piece is really in the core IT services. We're looking at the on-site part of the SP, and we do believe that we have a play in terms of bringing more productivity and get some margin benefits there. So I think while we are focusing on the core aspects on the dimensions that I talked about, digital revenue growth, the higher gross margin is also an important factor for us. And this time, we've also advanced all the salary hikes to April, as you have seen. And we've also kind of planned for higher variable pay in terms of if we achieve the targets that we have set ourselves. So all these elements are part of our guidance.
Okay, thanks for that, Mr. Luck.
Thank you. The next question is from the line of Yogesh Agarwal from HSBC. Please go ahead.
Yeah, hi. I just have one clarification. Ranga, in FY17, Panaya and Skava were around $100 million revenues. So, assuming they were down, let's say, 20% in FY18, so around 80 million. Are you assuming any revenues in FY19 in your 6 to 8% guidance, or you maybe for 6 months, or you're not assuming any numbers?
No, let me clarify. I think both Panaya and Skava put together, the revenues are not material for us.
Okay, so it doesn't matter whether you're including...
not material for us, and that will not impact the guidance that we have given. And in fact, the 6 to 8 that we have given takes into account it's purely organic, and Panaya and Skava revenues are not material for us.
Got it. Thank you, Ranga. Thank you.
Thank you. The next question is from the line of Brian Burgeon from Cowen & Company. Please go ahead.
Yes, hi. My first question, can you talk about your expectations for the flow of revenue growth throughout the year as it relates to 6 to 8%? How do you expect that to progress throughout the year?
Hi. And if you look at the Q4 revenue growth, just concluded quarter, the year-on-year has been 9.2%. And if you compare and during the course of fiscal 18, we have seen improvement in the year-on-year growth quarter-on-quarter. So, for example, Q3 was 8%. Now Q4 is more than 9%. I think that is, and also we have got a decent exit rate that we have seen. Unlike some of the previous years, Q4, we have had a decent exit rate. And typically, as you know, we are looking at, given our earlier profile, Q1 and Q2, typically our first half typically happens to be stronger than the second half. That has been the past pattern. But without even, I don't want to give a sense that, look, that is going to continue. But having said that, the good exit rate that we have gives us confidence, saying that, look, Q1 and Q2 or the first half would be broadly in line with the pattern that we have seen in the earlier years. So to answer your question, it is not back-ended. The question is if it is primarily Q3 and Q4 growth is where it is. That's not how we have planned for 6 to 8.
And my next question, can you discuss your plans as it relates to augmenting the strategic consulting capabilities?
Hi, this is Salil. In terms of consulting, the approach we want to put in place is we expect a significant amount of growth coming from consulting, given that's the area that works closest with the business user. We are working on our own consulting business that Praveen shared with you, had fiscal 18 and fiscal 17, which were difficult years for it. We now put in place a turnaround plan to get that consulting really focused on where the market is going in terms of some of the digital elements and quite a lot of the business linkages that we need to scale up with the non-CIO buyer on the business side. That is the level of consulting activity that we have, which is what we need to enhance in fiscal 19, and we hope to do that over the next 12 to 18 months.
Thank you very much.
Thank you. The next question is from the line of Girish Pai from Nirmal Bang. Please go ahead.
Yeah, thanks for the opportunity. I just had a couple of questions. One was regarding the capital return. Is there any regulatory issue that could prevent you from making a buyback of this 1.6 billion in FY19?
Well, If you look at the April 2017 policy, based on that we did the buyback, right? We did the buyback of up to $2 billion. We just concluded. There are no restrictions. Of course, we have to go by the guidelines in India. In SEBI guidelines are very specific on periodicity and etc. But there are no restrictions. But what the board has said is it has identified 1.6 billion, and the mode of disbursement it will decide later. So that's the thing. It's not about any restriction.
No, the periodicity part, would that prevent you from making a buyback in FY19, or would it be a 4Q FY19 event?
In India, of course, there is a time gap that is there between two successive buybacks as per the SEBI guidelines. Typically runs about 12 months. That has been the broad timeline. So that's one aspect. But beyond that, there are no restrictions. But as the board has clearly said in our capital allocation policy, we have earmarked, and the mode of disbursement, we have kept it as flexible, and that will be decided by the board at some time.
Okay, my second question is with regard to the mix between new and renew of this $3 billion large deal TCV number. If you can, you mentioned, Praveen, you mentioned a certain number for 4Q, but if you can give for the full year, how much the number is?
The full year, the number is over 3 billion. So for Q4, it was 905 million. So on an average, it has been about 750 to 800 million in the other 3 quarters.
No, the mix between new and renew.
Oh, okay, sorry. Yeah. The new is about 32% net new out of the 905. For the year, it's about 30%.
Okay, thank you.
Thank you. The next question is from the line of Pankaj Kapoor from DM Financial. Please go ahead.
Yeah, hi, thanks for the opportunity. So on the digital, it seems that there is some kind of a realignment in your priorities and the portfolio which you are now trying to target. That appears to be more closer to what your peers have been focusing on for some time. So my question is that do you think that you could be at a disadvantage here as others have already moved much ahead on this?
First, what's interesting to see is the existence of our digital capabilities today. So today, we already have 2.8 billion of digital work in the detailed digital services architecture that we've developed. And it's now growing, as I shared earlier, quarter on quarter at quite a rapid pace in fiscal 18. And we see that continued ahead. Yes, very much our focus now in the future is this becomes the growth engine for us, given our clients' future relevance to this sort of work. We want to make sure that we invest and build this out so that we have all the full life cycle of digital capabilities available for where our clients are going.
Okay. And Praveen, in the $3 billion of deal win this year, were there any digital deal also part of that?
Sorry?
Of the $3 billion deal wins that we announced. Yeah.
See, each of these large deals has an element of digital because many of the deals have an element of cloud migration and legacy transformation and so on. We have not segregated or computed how much of percentage of digital is. Whatever the extent of digital that is counted towards the 25.5% of or the 2.8 billion that Salil talked about, we have not tracked at the deal level to say what percentage of this 3 billion is digital.
Sure, understand. And lastly, just Ranga, clarification, the investment in digital and reskilling that you are talking about for the margins outlook, is it building in any impact of any acquisitions also in those areas as part of this?
No, we are not looking at the acquisitions impact on this. It's primarily on the investments that we need to make either by way of service line investments, either through the employee-based investments or some of the IP-based investments. It doesn't take into account any acquisition costs attributable to these areas.
Sure, got it. Thank you and all the best.
Thank you. The next question is from the line of Ashwin Mehta from Nomura. Please go ahead.
Yeah, hi. I had one question. You seem to be indicating a higher wage hike this year. Do you think this could be an industry phenomena or this is more Infosys specific?
No, the wage hike is in same range as what we did last year. So I don't see any difference. So like last year, we'll continue to differentiate. And majority of the people, as I said earlier, will see wage increases, particularly in India, between mid-single digit to high single digit, consistent with what we have seen in the last year. And it's in line with what we are seeing in the market.
Okay. And the second question is in terms of subcontractor expenses. They depressed your margin by almost 50 basis points in FY18. Do you think this will go up further given the duration-based restrictions that are coming up on visas?
See, one of the things, as you know, the need for subcontractor comes essentially when it's primarily, of course, it's more than 95% on-site. And it comes primarily when we do not have the required skill set manpower to staff a particular project on time due to non-availability of visa or the person not being available or stuck in some other projects and so on. I think over the course of a year, we have taken actions in terms of making sure that subcontractor thing is the last option after exhausting all the options. And at the same time, there are several projects where lack of availability of couple of resources, especially in digital kind of projects, will decrease the ability of the company to go after those projects. And what we have done during the course of the year is also that the price points at which these subcons are deployed in our projects are higher, to make sure that there is a fair amount of diligence and discipline on the margin for the subcontractors. So this is something that we are addressing on one front. On the second front, the U.S. talent model is really the core vehicle that we are looking at to make sure that the supply chain aspects that I talked about, ability to staff engagements on time without really getting impacted by the visa issues, is the second lever. I think both are important for us, but in the short term, I think we are comfortable with the current level, and as we move much more towards the U.S. talent model.
Okay. Just one small one. In terms of digital, you talked about what your QOQ growths were. Can you share what the YOY growth in digital was this quarter?
At this point in time, we we're able to share QOQ, and from Q1 onwards, we'll be providing more color on the digital revenue so that there is a trajectory that we could depict for all the investors and analysts to track.
Okay. Thanks a lot and all the best.
Thank you. The next question is from the line of Sandeep Shah from CIMB. Please go ahead.
Yeah, thanks for the opportunity. Salil, just want to understand what all 3-4 parameters you will look for to measure the achievement of your strategy which you are putting forward starting from FY19.
So for us externally, the measure that we will start to be very focused on is this 2.8 billion revenue that I've referenced in fiscal 18 and how that trajectory expands specifically in fiscal 19 and in the years to go ahead. Internally, we'll start to look at how, if I can call it that, this digital index works across our sectors, across our accounts, what the percentage of reskilling is within our employee base, how we're looking at our account expansion parameters internally and what percentage of that is focused and coming from digital. What is our gross margin and pricing that we see in our digital business? So internally, we've defined 6 or so parameters that show me where we want to drive this business. Externally, we're more focused on the growth of this absolute value of the 2.8 billion.
Okay. And second, on the large deals, just on the traditional IT, you believe that achieving this mark of close to $1 billion is achievable, or it would be still a work in progress?
Our ambition is to reach that. We are almost there. On an average, we have been doing about 750 to 800, and this year we ended up 900. But sometimes the challenge is some of the cycle times are longer than we anticipated. Some of the deals get pushed to the subsequent quarter. But looking at the pipeline, we feel that it's achievable, and that's where we are focusing on.
Okay. Just last question on the margin guidance of 22-24%. Based on the reply to the earlier question, it does not relate to a contractual profitability. So it looks like it's an investment to drive the growth. So is it fair to say that because your growth trajectory of 6 to 8% is not materially different than the 5.8% in FY 2018, so that shows the margin compromise has not leading to kind of a growth in FY 2019. But is it fair to say that once this investment is there, over the next 2 to 3 years, the growth comes back to a high single digit to a low double digit, and your margin can be leveraged because of the growth?
Well, I think, as I clearly said earlier, this is not on account of any particular contractual contraction, either on volume or on price or anything of that sort. It's not due to any of those factors. It is purely based on our intention to invest in digital areas, to accelerate growth in those areas, and revitalize our sales to make sure that we are better placed to capture the growth in the coming years. I think that's the whole intention. At this point in time, we have guided for 6 to 8 in FY19. At this point in time, we do not want to comment beyond FY19, but our endeavor would be that these investments are for growth, and they are not one-off chunky investments or chunky costs to address any particular contractual contraction.
And just one clarification, this guidance is on a constant currency, or when the rupee depreciates, Ranga, you believe that the pressure in terms of this guidance would be slightly lower?
Well, I think the 6 to 8 is certainly constant currency. If you're referring to the margin, yes, and when we give margin guidance, we always assume certain, currency movement vis-a-vis rupee. So that has been baked into the amount.
Okay. Thank you and all the best.
Thank you. Ladies and gentlemen, this was the last question for today. I now hand the conference over to management for their closing comments. Over to you, sir.
Thank you. Thank you, everyone, for joining in for this call. In terms of our closing, really delighted. We've had a strong Q4 and a strong closing of the year. Q4 starting to see growth at 9.2% and a strong operating margin performance. In terms of looking ahead, we are clearly focused on the 4 pillars of our strategy. First, scale out our agile digital business, which is 2.8% today, which grew Q4 on Q3 by 3.6%. Second, energize our core, apply automation and artificial intelligence, and really drive productivity improvement into that on an ongoing basis. Third, reskill our employees. And fourth, localize in our market, starting especially in the U.S., with talent and capability. We believe this is a strategic direction that is going to give us more and more relevance with our clients' future. And we're looking forward to execute that with the investments that have been outlined for those growth areas. With that, our guidance for fiscal 19 reconfirms as what we've discussed today. 6 to 8% in constant currency terms revenue growth, 22 to 24% operating margin. Thank you, everyone, again, and look forward to catching up on our Analyst Day, Investor Day, and the future calls.
Thank you very much, sir. Ladies and gentlemen, on behalf